Top three things this morning in my notebook. Number one, going to hit on Hong Kong. Number two, going to hit on Europe. And number three, obviously, on the VIX. First on Hong Kong, okay, so one thing, it's been crashing, so that's not new. Two, everybody and their brother, sister, and their dog are talking about everything that's going on in China and Evergrande this morning. That's not new. So again, it is what it is. The best way to deal with non-contagion, I guess, is just to be short of China and Hong Kong. We've been short China since Q1 of this year, and we added Hong Kong on June the 22nd, so that down 3.3% overnight with the rest of the markets closed. That's another big part of this. Don't forget that with Australia and Hong Kong being one of the few places open on the eastern side of the world, that's where the liquidity went. We're not long either of those markets, so that's fine. And then they opened Europe down, and now it's down even more. On what? I don't know. I guess you could tell me. I don't particularly care. It's where they close the markets today that matters. In particular, what happens after you get this episodic or not. You never know until you know. But again, this is not what happened last week in the USA. Don't forget, we're in European economic data. So just to hit on that, on Europe in particular, Europe's down, again, signaling oversold. It's rare that you get a trifecta or a foursome of oversold signals in Europe, which would include the four that we like. So you're going to get all of those today. If you don't want to buy Europe, don't buy Europe. I'll be buying Europe all morning. Provided that I can keep myself together here with whatever food poisoning it is that I got. But that's what it is. I'm going to buy the euro again. I bought some euros on Friday, and I'll buy it again this morning. So there's a lot to do here. Interest rates down this morning in Europe as opposed to up, which they were on Friday. So again, if you look at the whole continuum, and that's easier to read in the early look note this morning of what happened last week. It was actually a quad 2 week last week. The Russell was up last week. Bond yields were up last week. The 10-year yield was up. That is, and you had high yield spreads down. Gold was down 2.something%, and utilities were down 3%. That's a quad 2 week. This morning, whatever this morning is one morning. We're gonna have to see, but you just got to deal with it. There's not a lot you can do, really. I certainly didn't make the call that futures would be down 80 handles on SPYs. But when you just jump into that point number 3 this morning, coming into that, the particular setup was one that I was a buyer of, and I will be a buyer again this morning. And if I'm wrong, I'm wrong. If I'm right, I'm right. That's the game. Play it. There's nothing out there that would change my mind fundamentally. We have earnings season coming. Obviously, we have coming into it implied volatility premiums that are through the roof. So that's just going to add the fuel to the fire. 70% this morning was the implied vol premium on SPYs. You had a 62% on Qs. XLY, which continues to shape up, and that was up on the week last week alongside energy. And again, that was a quad 2 type set of outcomes. Also, high beta stocks were up last week. Those are, again, quad 2 probability continues to rise. I know that that's not what the people that are watching CNBC are talking about this morning. They don't even know what that is. But I don't care. Commodities were up again last week too. That's another clear-cut signal that it's not quad 4. Dollar overbought, that's another big one. So again, where is the VIX going to pop to? Well, it's going to pop to where it pops. Unless you can call God and tell him to stop it from happening for the first 3 minutes, what are you going to do with that? I'll typically wait the first 20 minutes of trading anyway to do anything. I typically don't send out any real-time alerts till after 9:50 a.m. for that reason, because you just don't want to be that person. Certainly not for the amount of years that I've been playing this game. You don't want to be the person panicking or puking, puking in market terms on the open. That's just not a spot to do it. So we'll see. VIX went out at 20, spot 81. It can go to 23. It can go to 25. It can go to 28. Unless it gets above 29 and holds there, you're really not doing anything other than setting up for the next move back towards 14, 15, or 16 on the VIX, which, again, nobody's going to see happening until it happens. And by the way, the U.S. stock market could close up by the end of the day. I know some of you probably don't believe that if you're new to this, but this, of course, has happened before. And what you'd prefer to see the bears do is have a panic attack on the open on the first day of a week with a big narrative that is contagion risk than anything else. I'd much prefer the bears be more bearish than they have been. If you look at futures and options contracts as of last week, you have, again, a net short position. You see the green arrows there. They're green arrows to me because I'm getting longer. So again, green arrows on S&P index and E-minis. Obviously, the Russell's still a net short position. There's a short position in the Nikkei as well. And people are long dollars. So the consensus position is the position that the market has this morning. It's been wrong, but again, it's going to be a good test of your emotions and or your process or both. Again, be heavy on the process and very light on the emotions this morning. And those are your top 3 things.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.